Welcome to another edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and today we're going to talk emerging markets with Northcape Capital portfolio manager, Patrick Russell. Welcome, Patrick.
Pleased to be here.
Good to have you on today. Now, obviously, I always do the general advice disclaimer. Anything that Patrick and I discuss today is general advice only and general in nature. Anyone acting on that advice does so entirely at their own risk. Please seek professional financial advice if you would like to follow up on any work around emerging markets and more specifically on North Capital. Now, Patrick, let's talk a little bit about who Northcape is and how and why you fell into emerging markets.
Thank you for that, Christian, Rob. And Northcape is a private group and it's employee owned. We're not owned by an outside bank or institution. The employees own the company. And so you've got this tremendous alignment between the company, the employees, and the clients. And we're here for the clients only. And we think being privately owned maintains that integrity in terms of our client focus. We're not focused on revenue maximization, profit maximization, building a business up for sale. We're here for the longer term. We're here for our clients and getting performance that is optimal for our clients over the longer term is going to be good for our business as well. So we started in 2005 and we're now over 20. We're coming up to our 21st year. And we're a pretty large organization. We have close to $20 billion under management. We're a scale firm. We have nearly 40 staff. We have a very strong balance sheet, plenty of scope to invest in the people and in our research and in all our capabilities. The EM product was launched after the Australian product. The Australian product was launched in 2005. The emerging market strategy was launched in 2008. I was the founder of the EM strategy. So I basically joined Northcape and launched the strategy. I went on the board of the company and seeded the fund at the inception. And really, from my point of view, I always had a passion for emerging markets, developing countries. It goes way back early in my life. I studied in postgraduate developing country economics, and my first job was actually in New Zealand working in the Department of Trade and Industry as an economist and sort of part of ultimately had this aspiration to work in foreign affairs in these countries. But I was eventually romanced into the finance sector, into stockbroking, investment banking, and my expertise was telecoms, media, and technology. And while I was working in this industry for Bank of America, formerly Merrill Lynch, I started to work on emerging markets from about 2001 and really got some exposure to some amazing, remarkable countries. And I actually decided to leave Merrill Lynch, resign, and then look at setting up emerging market strategy in Australia, focusing on this asset class and investing in these wonderful business opportunities that were omnipresent in many ways, but also that's a pretty broad church and there's a lot of variation, and that makes the asset class very exciting. So it really is a stock pickers asset class, not a homogeneous buy all index type approach. And I really liked that. It resonated with me, and more particularly with Australia, we are richly endowed in really highly capable research, analytical minded people. And so I could see an opportunity to set up a world-class emerging market strategy domiciled in Australia. And in fact, we were the first one to be based here. And a lot of people said, hang on, why aren't you in Hong Kong, or why aren't you in London or Edinburgh or New York? But we were based in Melbourne, and we've assembled a phenomenal team of talent. There's 8 of us in it. And we all share this common passion for investing in emerging markets. And I think while you've got the passion and you've got a highly disciplined, proven process and motivated people supported by a company with the right corporate culture, you've got all the ingredients for success and sustained success at that.
the fact they've been doing it for 20 years tells you that it's been successful thus far. So congratulations on that. But given your passion, and like before we go through the questions here, emerging markets, what are they like? Is it correct? Is it 24 different geographies that make up the emerging markets index?
There's 20, yeah, correct, Rob. There's 24 countries in the Emerging Markets Index, the MSCI Emerging Markets Index, which came into being in about 1987, 88. So it's not an ancient asset class. It's about 40 years old and it has evolved quite a bit. But it is not homogeneous in any way, shape, or form. There's an enormous amount of variability between these 24 countries. And therein lies the challenge to have a research approach that measures and takes account of sovereign risk, but also understands what a really good business is. And in retrospect, or in contrast, where you can come unstuck is that you take a developed market framework to prosecute an emerging market strategy, and you don't really have a sovereign risk overlay, because really in developed markets, sovereign risk is not a big part of the solving the equation for investment. It's largely a bottom up. But in EM, you can have the best stock, but if it's in the worst sovereign, it won't beat the worst stock in the best sovereign. And so the sovereign risk piece is a vital ingredient in terms of solving the problem and getting the best outcomes.
Russia's a great example of that.
Correct.
Yeah. Given your 20 years and even the 40 years that EM's have been around, the industry's been around, what have been the main drivers that determines performance for emerging markets?
I think, as I mentioned, it's company and sovereign, the two together. So we do find that the best returns come from jurisdictions where you have very, very strong backing of corporate law. So you want to invest in a country where the judiciary is independent from the state, you have a degree of freedom of press, freedom of assembly, and you have the checks and balances around corporate law to prosecute renegade behavior. If you don't have those institutional pillars in place, then you're vulnerable to corporate governance breaches. And as a consequence of that, you're vulnerable to significant capital loss risk. So you want to take that risk off the table first and foremost. So we do a lot of work analyzing the legal system we're investing in and what rights we have as a foreign shareholder protecting our client capital. And if it's not there, we don't invest, even though it might be 20% or 30% of the index, as is the case in China. You have no protection. There's no employed in your class action as a shareholder in that market. So if you get that, you've got the checks and balances around management in terms of the penalties for breaching. Okay? Once that's in place, you've got the governance framework for better corporate behavior. And that's the first base you've got to get to. You can look at, okay, we've got the legal system that supports us. Now let's look at the business model, the growth opportunity, the return on capital. But more particularly above that, and it dovetails with the corporate governance piece, we tend to invest in businesses with no debt, okay? Now that you might go, hang on, this is not right. There is an efficient capital structure, and that is a mixture of debt and equity. So if you're not having any debt, then you're running at a higher cost of capital, and that's inefficient in terms of capital allocation. But people don't understand necessarily in EM, when you get a shock in these investment markets, and you get them, okay? And to believe that you're not going to get one is basically somewhat naive in our view. And you don't want to be owning highly geared companies because they end up selling their prized assets at the bottom of the market because there's limited capital provision. The depth of the capital markets, debt and equity and bank, syndicated loans and whatnot, it's just not there. So you have to run with much lower debt.
Yeah.
So as a consequence of that, we tend to own debt-free companies. So when there is a shock, they end up buying the beachfront property at the bottom of the market at a price that is generationally transformational. You don't want to be on the other side of the transaction where you own a good business, but they're forced to sell their good assets in a fire sale. situation. So we have this optionality in our portfolio of owning these richly endowed businesses in terms of capital adequacy. And literally in any sector, they can cut a check at any time where none of their competitors can, and they're not dependent on equity or debt finance of their business. So I think that's an important distinguishing factor. Again, if you come from an advanced capital market approach, you won't think of, you just say, hang on, I want to invest in companies that have got much more efficient capital structures, a much higher level of debt, but they don't understand the asymmetric nature of shocks that can basically cause the whole capital market literally go into cardiac arrest. You can't raise any money at all. So you're forced into a sales situation. Again, another source of permanent capital loss. You never recover from that.
Yes.
So when you think about it, what we're trying to do here in EM, it's winning by not losing, okay? That's what you're trying to do. Protect the client capital at the sovereign level in terms of having the protection in terms of corporate governance, and then protect yourself at the bottom up, at the company level, by owning cash-rich companies that are generating free cash flow and they've got cash on the balance sheet and effectively no debt.
Yeah. Now, in some pockets of equities at the moment, there are perceptions of bubbles. Valuations are stretched. How do valuations look in the emerging market space?
We think they look pretty good in the countries that we're investing in because we do take a different cost of capital for each market. And what we tend to do in our sovereign risk, if it's a risky country, we would say we need to put a much higher cost of capital in that market. So if we're investing in a retail business in, say, a country like China versus one, say, in India, we'll be using a much higher cost of capital for that same business. Put it this way, we might use a PE of 25 times or 20 times for the Indian business, but we might use 5 to 10 for the China one. Still own it, but we want the compensation for the higher sovereign risk in those markets. And when you risk adjust the portfolio, we think it's reasonably priced. But you don't get valued in the way that you would see it. Because often if you're a value investor, you go, okay, I'm going to own these Chinese equities because, or these other equities, they're trading at 5 or 6 times or 7 times because they're much cheaper than, say, India or Mexico or Indonesia or Korea or whatever. That's not taking into account the sovereign risk. And this is precisely what happened to Russia. It was trading on a market P of 6 times, looked very cheap. But even at 6 times, it didn't reflect the risks that you were undertaking in that market. And then when they invaded Ukraine, it was 100% capital loss.
Yeah.
You lost everything. So looking at the naked PE is very dangerous if you're not taking into account all the risks that you're confronted with in that particular market.
Yes. So now over the last decade or so, emerging markets have underperformed developed markets. Obviously, more AI in the US, and obviously that's driven the growth and lower rates, blah, blah, blah. Where are we in the cycle now for emerging markets? We've spoken about valuation. Are there tailwinds coming for emerging markets?
From our point of view, when we invest, we don't invest for strong dollar or weak dollar.
Yeah. Okay.
Our strategy is compounded at sort of 12% since inception. And we've done that with a strong US dollar and a weak US dollar. It's like we're an all-core player, if you will. And we do that because we're investing in businesses that have got really good governance and they've got the corporate law protecting the shareholders. They've got really strong balance sheets and they've got really good business models, high return on capital, and they're executing into large market opportunities so they can compound in year after year, decade after decade, and create shareholder value. Then you might get a tailwind of weak US dollar, so the funds are flowing into EM and the returns are even higher. And then you might get an environment where the US dollar is strong, and then you've got funds flowing out of EM into US dollars. And we've managed that. I think if you look at the last 10 years, we've basically been sailing into a headwind of the strength of the US dollar until this year where it's corrected. And to our way of thinking, yes, there might be the opportunity that we could jibe the boat to use a term, and then throw the spinnaker out and sell even faster because we get a tailwind of a weak US dollar. And that is not impossible because this US exceptionalism, which has driven dollarization in portfolios worldwide, manifested in this AI boom and tech boom, that could really come off the boil. And if it does, then the US economy, which is driven by AI spending, basically goes from premium growth to the world to discounted growth. Then the Fed has to cut more aggressively, and then you might be in a situation of extended dollar weakness.
Yes.
And we think that is out there as a potential risk, that EM represents a marvelous hedge against AI capital expenditure normalizing and that bubble deflating. It will be a negative beta asset on that and justifies portfolio exposure. But away from that, even if that happens, hey, we'll take everything we can get. But we're an all-corp player. The stocks that we own will just keep delivering shareholder returns because they're great businesses executing a really good business model against a large market opportunity, and they've got plenty of capital. And the other thing worth reminding the listeners is that we're in a world where the cost of capital is going to be structurally higher. There's no question. The days of negative real rates are gone, and that was 2011 to 2022, 23. And we've just got so much variability and unknowns in the world. We've got shrinking labor pools in developed markets, so that's the pressure on wage costs. We've got significant increases in global debt levels, particularly in the US, Europe, UK. That's putting pressure on long-term rates. Then we've got issues around central bank independence and credibility in the US. Again, another issue on rates and US dollar. And then we've got this whole issue of trade wars. And then US pulling out of the global rules-based system. So all these factors are creating a sort of compounding level of risk, and that's driving almost like a non-linear rise in risk premiums. What does this mean? It means the cost of capital going forward is significantly higher in the next 10 years than what it was in the past. And it's just going to be much harder to set up new businesses, particularly in EM where the cost of capital is even so much higher. And so what we see in EM is significant industry consolidation over the next decade. And so we've really positioned the portfolio unequivocally in the number one players. They're going to be the key beneficiary of industry consolidation. They're going to have better pricing power. They're going to have higher margins, higher return on capital, more cash flow. Plus, some of their competitors are going to fall over because their business models were requiring capital to be funded. And they'll take more market share. They might even buy some of them. And so we're in a situation where these businesses are going to get stronger and stronger. And that's going to be a factor in improving their returns for shareholders. I think it's going to be most pronounced in EM, this global consolidation, because the cost of capital is going to be structurally so much higher than what it was in the past.
So if I try and explain that for the listeners in the Aussie context, so you're trying to identify the real estate.coms of emerging markets, the Seek of emerging markets, the number one player in their particular field, where it's very difficult to replicate, competitive advantage is high, returns on equity is high as well. So you want to back those companies because the tailwinds of emerging markets are growing faster than developed markets. Is that fair to say?
Yes, I think those are good examples. And we also sense that the competition against those businesses could be significantly less going forward than what it was in the past. The only thing is AI going to disrupt their business model? Is there a competitor coming with AI? So we have to be careful of that as being a left field disruption. Big area we're seeing it is in telecommunications. I mean, we're basically seeing this industry, particularly in EM, go from 4 players in a country to 3 to 2. So the incumbent player is now in a situation which is stronger than what they've ever been before because the level of competition. And why is it's just the capital cost of providing high bandwidth capability in a ubiquitous basis is very expensive. That's at home, at work, and on the move. And the capital cost of that industry is so high that really there's only two players that can afford it. So when you've got negative real rates, there's whole new telcos setting up, they're competing against the majors, they're raising debt and equity finance, they're expanding their networks, and then all of a sudden the cost of capital goes up and they can't raise the capital. They can't expand their networks to the extent they can, but they're not at scale, so they're not profitable. So then they have to either start raising their prices significantly to get cash flow, or they just put themselves up for sale.
Yep.
And that's what they're doing. And so the industry consolidates. And you're seeing this in banking, you're seeing it in retail, you're seeing it in telecoms, you're seeing all kinds of industries. It's consolidating in it.
Well, just on that, Patrick, do you want to give us an example or two within that banking and retail and telco space of some of the investments you have?
I think one of the portfolio stocks we've got is American Movell. This is the leading telecom stock in LATAM. It's based in Mexico. And if we go back 10 years ago, they had a lot of competition coming into their business, largely competing with voice services, and SMS. Now, with that, you don't need a lot of capacity on your network. You can do it with a pretty thinly capitalized telephony network. But then we migrated from there to low-end data, to high-end data, to high definition, to AI. And now we've got these massive gigabit capacity computers in our pockets. And so the network capability requirement is that you have to have a lot of fiber optic cable. You have to have a lot of capacity in terms of undersea cable. You have to have data centers. You have to have a whole range of services and IT capability. And really now you're seeing that industry consolidate, and they've been a big beneficiary of that. We look at Mexico, it was once a 5-player market. Now it's like a 2-player. You've seen rationalization in Brazil from 6 to 3, Argentina 4 to 2, Chile 4 to 2, Peru, Colombia. And they're not literally the last man standing because they've just invested so much in providing a world-class service that they're the only ones that can supply it. And the regulator has got very little option. They've just got to say, you have to let them stay. You can't regulate them out because they're the only ones investing.
Yeah, they need
and as long as they keep doing that, they're going to get an acceptable return on capital. And that's a very good example of what we're seeing in terms of industry consolidation, proving returns on capital. And then they've got a huge market opportunity in terms of growth in those services as incomes rise, as penetration improves in terms of data services and related services from there, which is significant relative to what we see in developed markets. And they'll do it with a higher margin and a higher return on capital than what they would have done 5-10 years ago.
Oh, fantastic. Now, I know you and the team have released a paper titled The Importance of Quality and Sovereign Strength. For those listeners, it's worthwhile having a read. It's actually on the website, the Northcape Capital website. I've flicked through it and highlights the processes that Northcape go through. We've discussed already some of them, cost of capital, sovereignty. But one key point there was obviously, how do you consider sovereign strength or weakness into every stock decision you make? How do you rank the countries or the sovereigns that you look at?
Yeah, great question. So when we look at a country, we look at a whole raft of variables. So a big part of the assessment is the judiciary independent. Do you have proper corporate law? Do you have a democracy? So if you don't have a democracy, then there's limited checks and balances on the government. And then basically you probably don't have independent judiciary. It gets captured by the government. So then you've got an environment that is very vulnerable to corruption, extremely vulnerable to lack of transparency. When you look at the countries we like, the ones that don't like, that is a big part of the equation. Other things we look at is what is their fiscal spending level like, and is there disciplines that limit fiscal irresponsibility? Because one of the things that can happen in EM, you can get a government that can be democratically elected, and they really just want to spend a lot of money, a huge amount of transfers, and they're in a situation where they blow the deficit out, and then they might say, we're not sure how we're going to finance that deficit. We don't want to raise taxes, so we'll monetize it by quantitative easing, i.e. they'll get the central bank to start printing money. Now, that's fine. If you're the EU, the ECB, or you're the Bank of Japan or the Federal Reserve, you've got a reserve currency. It gives you some latitude to do quantitative easing, but there's no EM currency that is a reserve currency. It's a currency that needs these protections in terms of institutional systems to create the integrity of the quality of those currencies. So if you go down the path of QE, they're going to say, you're printing money, I'm out. And so they start selling the currency down. That drives down the whole kind of FX reserves in the central bank, because they're trying to defend the currency, and that you get a kind of fight between capital leaving and then the central bank defending it. And who wins? The local central bank always loses. It never has enough money to fight global capital markets. So you start to see an accelerated depreciation in the currency. That increases inflation because the cost of all your imported goods goes up. And then you get caught in this devaluation, inflation, death spiral, because the more the currency goes down, the more inflation goes up. Then people's wage rates have to go up, because then you have social instability, and you're caught in a currency fall. And the only way out of it is the government has to basically then put in capital controls on the currency. So it's no longer convertible, and it's no longer free traded. So as soon as that happens, you're kicked out of the asset class. You're no longer EM. So that's serious. And when that happens, you just get an avalanche of selling. And that's precisely what happened to Russia. They had to put capital controls on, and there were capital controls forced by other agencies, and then it was immediately disqualified from the asset class. So when you look at sovereign risk, you have to guard against countries that have the risk of getting irresponsible with their fiscal policy and then undermining the independence of the central bank. So we're very mindful of watching that. I think these are some of the things we look at, and it has a profound impact on the cost of capital. And so what some markets we're using cost of capital's closer to 30% and some around 10. And if you're discounting a market at 30% cost of capital, you're not going to invest in that. Like Russia, we had zero in that market when the proverbial piano went down the stairs. We weren't in it. I think this is the issue, is capital loss risks at the sovereign level can be fatal, and you have to avoid them.
Yeah. And again, goes back to your point earlier about your checks and balances, because I think what also the market is underestimating here is the passive index and the flows that are dominating EM at the moment. And you guys have really got a process that identifies the sovereign risk, and that's your starting point. But when you look at passive flows, China's 30% of the emerging market index, isn't it, Patrick?
Yes, and I think if you're in a passive strategy, you're unwittingly taking on all the risks of these sovereigns that are very risky and prone to substantial capital loss risk. So it's about having an acutely selective, highly active strategy that really picks the best of the best sovereigns and the best of the best companies in those sovereigns at the right price. And then if you're in that area, it's actually in a situation where a lot of stuff gets disqualified. There's 1,200 stocks in the index, but then if you look at the ones that are disqualified because of these elements, you can then prune the list down to a much shorter universe, smaller universe, and really focus on those as the best opportunities and do your research on them.
Let's focus
That's
on
right.
the opportunity. Patrick, what is your most preferred sovereign and why?
We have a classification of preferred sovereigns today, and India's in there. We've got South Korea in there. We've got Taiwan in there, and we've got Poland in there. Those are the sort of the main ones that we've got in that market. And I think India would be probably the one where we probably see longer term is the most attractive. And it comes back to the fact that corporate law has been around in India a long time. The Joint Stock Companies Act came 1857 in India. And that was basically a derivative of the UK Joint Stock Companies Act of 1844. So you think company law has been around for almost 2 centuries. Okay, a formal companies law came in India in 1956, and it was updated again in 2013. So it means that you've got generations of companies and boards that understand company law, and they understand what happens if you breach it. And it creates a culture in terms of understanding in the boards, in the management, in the universities that are training people in management to come through about the rules and regulations around running a proper company. And as a consequence of that, you've got pretty good investor protection in India. Still, things can go wrong. And also, you have in India a much higher return on capital because the safeguards are there for shareholders. And as a consequence of that, the return on capital of an average Indian company is close to 17%.
Wow.
In China, it's less than 10. So there's a massive difference. That's the average, okay? And then you look at exceptional businesses in India, which we look at, are much better than exceptional businesses in other markets. Plus, they're executing against a big market opportunity and strong demographics in terms of growth and household formation and salary mass. So it comes down to these factors. Now, you can't be lazy or inattentive to risks in any market. So we're still alive to that in the context of all the markets we look at. And India is no exception.
Yeah. But the risk reward or risk adjusted returns are quite attractive at the moment for India.
We think they are, and the market in of itself has not performed as well as other EMs this year. It has actually probably been hurt by the trade dispute between India and the US. Also, in the technology sector, it's to some way been impacted by the impost of these additional fees on H-1B visas in the US for the Indian tech industry. But away from that, we're starting to see that those risks dissipate, and we're starting to see these trade deals starting to come through. And the Trump administration has been walking back some of the penalties. And the reason why is that inflation in the US has started to rise. And I think from their perspective, they were voted in on a cost of living crisis under the Democrats, and they were supposed to solve it. And that hasn't actually happened. And tariffs have actually exacerbated the situation. And I think it's now dawned on the Trump administration, hey, we better start repealing or reducing some of these tariffs to provide some sort of impetus in terms of cost inflation as we head into the midterm elections next year.
Okay.
So we, as a consequence of that, we actually remain quite constructive on EM trade as these kind of the tariff effect starts to wind down. And in particular, we think Mexico will benefit from a revision and updating and ratification of the USMCA agreement as well. And if you go back last year, a lot of these EMs were struggling because there was a lot of concern around tariff risks, around regulatory risk associated with the Trump administration, and we're now starting to see a normalization. I would add, and I came back to it before, if the AI bubble bursts and you do see a collapse in the capital cycle of this massive spending on data centers and potential significant stranded assets, US growth will slow quite dramatically. And that creates this situation where the Federal Reserve will have to be cutting. There'll be no option for it because outside of the AI boom, the US economy is not growing. And if AI is no longer growing and it's actually contracting, then you've got a recession in the US as a potential outcome. So I think the Trump administration is actually starting to get alive to that risk, despite all the hype around the sector.
Yeah. So in summary, Patrick, we've got Northcape that are emerging market specialists, been doing it for multiple cycles since 2005. You've got a clear process. You rank sovereigns. Sovereignty is probably more important than the process and the companies that you identify thereafter. You really have a focus on cost of capital, return on capital, and valuation. But then also you think about where we've been and where we're going. So the last 12 months have been headwinds, and now it feels like we've got a bit of a tailwind, weaker US dollar, tariffs unwinding. You've got this demographic growth across and GDP growth across your emerging markets, that you still have to find the companies that will benefit the most in those exposures. And that's what you and the team do. Is that fair to say?
Yeah, and that's an excellent summary of where we're at. I would remind people it's time in the asset class, not timing the asset class. I think we set this fund up 18 years ago, and it's actually with the same team. And that's phenomenal because we've got the experience. There's an enormous amount of muscle memory in this team from managing exposures within the EM equity asset class. And that is really rare. There's no substitute for experience. But one thing we have learned is that you just want to stay in the asset class over the longer term because it just has this wonderful compounding effect. And it's one of these asset classes where you can get 2 or 3 years of returns in 6 months. It can be quite violent in terms of the delivery of the return, and then it flattens out. And often people try and trade that and they miss it, or it flares and then they sell, and then all of a sudden it's back up again. And we look at these companies today and we say, really and truly, these companies are going to be a lot bigger in 5 years' time, 10 years' time, much bigger. So if the profit pool of these companies is going to be significantly bigger in 5 and 10 years' time, then by definition, the shareholder value, the market value of the company will be much larger as well.
That's
And
why
we
you
can
own
see
equities.
a clear line of sight for these profit pools to become manifold levels larger over the next 5 to 10 years. And it's structural. It's not cyclical. There may be elements of cycles within it, but it's underpinned by deep structural trends. I come back to it. We own the number one players who are also going to benefit from consolidation. And that's a new attribute they haven't had, an additional tailwind that wasn't present, say, 10 years ago.
Fantastic conversation, Patrick. I'm going to wrap it up there. Thank you so much, and thank you for your time.
Thank you very much. And yeah, pleasure to give you our insights on emerging markets.
Thanks, Patrick.